Hey guys, Jessica here. Today I'm going to be talking about startup equity. You know, that super complicated options thing that you get as part of your comp package when you join a startup that may or may not be worth a ton of money in the future. So I'm going to be talking today about how the options work, about taxes, ISOs, NSOs, early exercise, 83B elections, and more. So if you're curious about any of those things, or if you've never heard of any of those things, but you have options, you work at a startup, then stay tuned. So this topic actually brings up a lot of emotions. I know that sounds super weird, but basically my first experience working at a startup was when I joined a small London startup called Wise. It was called TransferWise back then, and it does international money transfer. And over the course of 3 years working at the company, I had an amazing time building product, an amazing time making friends. And a few weeks ago, TransferWise finally went public. So before I start, I want to say congrats to the founders, congrats to the employees and to the alumni. This is a culmination of a lot of hard work, a lot of doing the right things for customers all along the way. So kudos to everybody. And so I thought this would also be a really great time to talk about startup equity, because now I've seen that journey all the way through to completion, from not knowing anything about startup options to now seeing those shares actually become public and liquid and finally worth something. And so here it is. 5 things that I wish I knew about startup equity when I first joined a startup. Okay, so really quickly, high-level overview first of how options work. So say you're given 1,000 options as part of your comp package when you start. And let's say that there is a strike price or an exercise price of $10. And most startups have vesting schedules over 4 years. So that means they'll tell you, a big number of options you get, that 1,000 options. But those options only become yours in small drips, a little bit at a time, that vests over the course of 4 years. And vesting schedules are normally 25% at the end of year 1, then a proportional amount each month afterwards. So let me draw this out for you really quickly. So let's say you joined the company on January 1st, 2021. That's when you start. Then on January 1st, 2022, 250 options become yours. And then on February 1st, 2022, an additional 20.83 options become yours. And so on a monthly basis until January 1st, 2025. Then you get all 1,000 options. Now, all of those options are yours. And so if you were to leave the company, say on June 30th, 2021, you would get to keep none of your options. If you were to leave the company on, sometime in January of 2022, you would get to keep 250 options. And if you were to stay all the way until January 1st, 2025, you get to keep all 1,000 of those options. So that's basically how vesting works. And whenever you decide to exercise the options some point down the road, that means the options, you're going to pay this exercise price of $10, and then those options turn into shares, and now you own those shares. So let's say you do this at the end of 4 years when you have now 1,000 options. Say also, like the value of those shares now have become $100. It's grown from $10 when you joined the company. Now it's worth $100. That means that, over the course of 4 years, you've gotten pretty much $90 of value, times 1,000 options or 1,000 shares. And so the IRS is going to want its share of that $90, but we'll touch more on that in a little bit. So getting back to it, 5 things that I wish I knew about startup equity a lot earlier. Number 1, negotiate harder for startup equity at the start. I covered this in another video where I talk about negotiating startup comp. I'll link to that up here. But basically, the point is that startup comp is broken down into 2 parts, the cash part and the equity part. And the thing about the cash part is that this will hopefully go up over time. As you get performance reviews, as you do better and you get raises, things like that. There isn't really that same opportunity for equity. Equity is kind of fixed, or it's a lot more fixed than the cash piece. And so don't waste that opportunity at the start to ask for more equity. Number 2, options aren't all the same. So prior to joining Wise, I had heard a little bit about options, mostly from friends who had been working at startups. And I heard this thing that, hey, you need to exercise your options within 90 days upon leaving a company. And so after 3 years at Wise, I had taken a new role and was on my way out. And I remember hearing nothing about needing to exercise my shares. And I was getting kind of concerned and, writing to HR, all responsible and on top of my stuff. And I get the feedback, read your options contract. Okay, so maybe recommendation number 2.5 is to read your options contract. Anyway, there are actually 2 types of options. Incentive stock options, or ISOs, and non-qualified stock options, or NSOs. I had NSOs, and those friends I've been talking to had ISOs. There are a bunch of differences between these. Tax treatment with the IRS, holding periods, when you need to exercise by, the eligibility, all of these things can get pretty complex. And so I won't go into too much detail here. And also because actually as an employee, you most likely don't have the option to pick which one you want. You get what the company has and what they'll give you. Also, they both have pros and cons. It's not like one is inherently better than the other. It really depends on the situation. But if there's one learning here, it's that you should know which one you have, because knowing which one you have will allow you to look ahead, to plan ahead, to know the specific rules around that type of stock option, and then to be able to optimize for that type. For the rest of this video, I'm mainly going to be talking about NSOs because that's the one that I had. That's not to say that the things I'm going to say don't apply to ISOs. They just have very specific requirements. And so really keep that in mind if you have NSOs. And hey, if you guys want a video about ISOs, please leave a comment and let me know. Number 3, the final tax bill is hefty. So the way Wise had set up its options, I actually couldn't exercise until there was a liquidity event, an IPO or a sale or something like that, even if I wanted to exercise earlier. So going back to our example, remember how the shares are now worth $100. The exercise price or the value of the shares when I received them was $10. And so the difference between $100 and $10, I just made $90. Yay. The IRS is going to want its cut. For NSOs, you pay taxes upon the exercise of your shares. It doesn't matter if you sell them afterwards or not. But basically, you'll be taxed on the value of the shares, so that $100 less the exercise price, the $10. So basically, taxes will be applied on that $90. And the tax rate that will be used is the income tax rate, which is the highest tax rate. For federal, the highest tax bracket is 37.7%. And if you live in a high tax state like California, that could even be up to an additional 13.3% on top of that. And so, over 50%. For most people, it's probably going to come out to something below that. However, definitely expect a big chunk of money to go out pretty much straight away. And you won't even see that money. The company is legally obligated to withhold taxes from the proceeds, before they pay it out to you. And they do something called sell to cover. Sell to cover basically means that the company will go out and sell a bunch of your shares in order to pay the taxes and then give you over the rest. And the company is even legally obligated to use a very conservative tax rate, which means that the company will likely sell more of your shares than you needed to have sold. And then it's up to you to sort of claw back that money when you file your taxes in April. It kind of sucks. Number 4, early exercising could potentially save you a boatload of taxes. So this one I didn't find out about while at Wise, and only afterwards realized that some companies were offering this amazing thing. But if I had known about it, I would have asked about it, and so should you. So again, quick caveat, this is more relevant for NSOs. You can also early exercise ISOs, but there's a bit of trickiness related to that, so please keep that in mind. Basically, early exercising means that you exercise your options, you pay that exercise price, and those shares become yours even before they vest. And what happens then is that if you are able to do this early enough, like at the point at which the options are granted to you, then the fair market value of the shares and the exercise price are very close or even the same. And then you would be paying income tax on a very small number or even zero. If you do this, make sure to file the 83B election within 30 days. If you don't do this, there are potentially some ongoing, very painful tax consequences into the future. So file the 83B election. But basically, by exercising when the value of the shares are low and by filing that 83B election, you are able to eventually, when you sell in the future, to pay capital gains tax rates instead of income tax rates, and capital gains tax rates are significantly lower. Number 5, there's even the possibility to pay no federal tax. This one didn't apply to me at Wise because Wise is not a U.S. company, and so it wasn't eligible. But I do want to call this out because it could be huge. It's called QSBS, or Qualified Small Business Stock. So QSBS basically says that if you are an early shareholder in a company, meaning that the company hasn't yet reached $50 million in assets when you became a shareholder, then those shares that you bought, if you hold on to them for 5 years at least, when you sell, you're able to pay no tax on the gains of those shares up to $10 million. Again, there are a lot more specifics around this, but if you're at a startup, it's worth asking the company if they qualify, as a qualified small business. And that's it. It's been a crazy ride for me, and I hope sharing, a little bit of the learnings is helpful for you guys, at least in terms of, what to be looking out for as you're working at a startup, as you're, negotiating comp. If you want us to take a look at your specific situation and how to optimize, please feel free to sign up on our website. I've linked to it in the description below. We are a startup that is on a mission to take the tax and financial optimization strategies of the rich and make it completely free. Other than that, if you got value out of this video, please hit the like button and subscribe for more optimizations. Thanks.